of us know that we can diversify our mutual fund portfolios on the basis of size. So you have large cap, mid cap and small cap funds. But did you know that the way in which these funds are managed can have an equally important role to play in deciding the fate of your portfolio? So you have basically three styles of investing. The first is the value style. Now this style invests in stocks which are considered to be underpriced, or those stocks which are trading below their intrinsic value. Then there is the growth style. This is a style that invests in stocks which are growing consistently all the time and at above average growth rates. And then there is blend, which is simply a mix of both value and growth. So today, let's take a look at the value investing style. The basic philosophy of the value style is that the fund manager or investor buys companies which are available cheaper than their intrinsic valuation. So who decides what is cheap? The stocks which would be considered value buys would have characteristics like low price to earnings and a low price to book value. They would have a higher dividend yield normally and would be under-owned, meaning not too many big investors would have invested. Value could be relative to peers or historical valuations of the stock. Some typical examples of value stocks could be Bharti Airtel, SBI, Power Grid, NTPC and Coal India. So there are several schools or forms of value investing which have evolved over time. And many times this is also called contrarian or counter-cyclical investing. And a lot of people say that generally if you look at the historical performance of the markets, they say that the value style tends to outperform in bear market conditions. Value investing can also carry some risks. For example, it requires patience on the part of the fund manager or investor to see a market cycle, which can sometimes last 8 to 10 years, to play out to gain rewards. So naturally, this means that in the short term, there will be a big divergence in returns compared to the benchmark, something that may not go down too well with investors. And then there are value traps, or stocks which are available cheap, not because they haven't been discovered or have great potential, but because they have some inherent weakness in the business itself. So how can you tell if your mutual fund scheme follows the value bias? Perhaps the easiest way is to check the style box, which will display the orientation of the scheme. Some examples of funds with a value bias are HDFC Top 100, ICICI Value Discovery, ICICI Large and Mid Cap, and the Franklin India Equity Fund. So the reason it's important to know about the various styles of investing is because each mutual fund portfolio should actually have a judicious mix of value, growth and blend. It should not be heavily tilted towards any particular style of investing because each style performs in different market conditions, right? So if you have a good mix, it will ensure that a part of your portfolio is always performing no matter what. And remember, don't be too quick to exit an underperforming fund. Maybe it's just waiting for its cycle to turn.